Most people who have $100,000 sitting in a savings account are losing money every single day. Not because of market crashes, not because of bad decisions, because inflation is quietly eroding the purchasing power of every dollar that is not working. A savings account paying 0.5% on $100,000 generates $500 per year. Inflation running at 3% costs that same $100,000 approximately $3,000 in real purchasing power over the same period. The net result is a loss of $2,500 per year on money that feels safe. This is not a video about fear. It is about what $100,000 actually becomes when it is put to work in the right place. And the right place, for a long-term investor who does not want to spend hours staring at stock charts, is a handful of Fidelity index funds that have the documented historical returns to turn that $100,000 into something genuinely extraordinary. One of the 5 funds in this video has the potential to turn $100,000 into over $20 million over 30 years, and it is the last one we cover. Here is the number that makes this conversation worth having. The difference between $100,000 sitting in a savings account and $100,000 invested in a broad market index fund is not a matter of percentage points. It is a matter of millions. At the S&P 500's historical average return, $100,000 grows to approximately $1.7 million over 30 years. In a savings account at 0.5%, that same $100,000 grows to approximately $116,000. The gap between those two outcomes, $1.6 million, is the cost of inaction. And within the universe of index funds, the 5 Fidelity funds in this video have historically outperformed even that benchmark. The criteria for selecting them: growth potential, dividend yield, sector performance, and long-term stability. Ranked from 5th to 1st, each one better than the last. And the fund at number 1 has a 30-year projection that is almost difficult to believe, until you see the historical return rate that produces it. By the end of this video, you will know exactly which 5 Fidelity funds make the list, what $100,000 invested in each one could be worth in 10, 20, and 30 years, and which one has the highest long-term wealth-building potential of any fund on this list. So make sure to stay until the end, leave a like, and let's start. Starting at number 5, the Fidelity MSCI Consumer Staples Index ETF, ticker FSTA. This fund invests in companies that sell what people cannot stop buying regardless of the economy. Procter & Gamble, Costco, Walmart, and Coca-Cola dominate the holdings, making up over 63% of the fund. These are businesses that performed through the 2008 financial crisis, when consumer staples fell only 15%, while the S&P 500 dropped over 38%. FSTA carries a current dividend yield of 2.39%, with a 10-year dividend growth rate of 10.7% and 10 consecutive years of dividend payments. It is the most conservative fund on this list and the most stable. At an average annual return of 6.41%, $100,000 invested in FSTA grows to approximately $243,700 after 10 years. After 20 years, $681,000. And after 30 years, the portfolio reaches approximately $2,344,000, generating $165,400 per year in annual dividends by that point, or about $13,800 per month. For an investor who values stability and consistent income above all else, FSTA is the foundation. At number 4, the Fidelity MSCI Consumer Discretionary Index ETF, ticker FDIS. This fund takes the opposite approach to FSTA. Instead of essentials, it owns the companies people spend money on when they have disposable income. Amazon, Tesla, and Home Depot make up nearly 39% of the fund. From 2010 to 2020, the consumer discretionary sector returned an average of 16% per year, compared to the S&P 500's 13.3%. FDIS carries a modest dividend yield of 0.76%, but its 10-year dividend growth rate of 11.22% shows consistent and accelerating payouts. At its average annual return, $100,000 in FDIS grows to approximately $315,900 after 10 years. After 20 years, $995,000. And after 30 years, approximately $3,133,000, generating nearly $20,000 in annual dividends by then. This fund moves faster than FSTA and carries more sensitivity to economic cycles. But for the long-term investor comfortable with that volatility, the 30-year outcome speaks for itself. And this is only Fund 4. Wait until you hear what Fund 1 looks like. At number 3, the Fidelity MSCI Healthcare Index, ETF, ticker FHLC. Healthcare is one of the most resilient sectors in any economy. Demand does not disappear during recessions. During the 2008 crisis, while the S&P 500 dropped 38%, the healthcare sector declined only 22%. FHLC is dominated by Eli Lilly, United Health Group, and Johnson & Johnson, with nearly 100% of assets in healthcare stocks. The current dividend yield is 1.26%. Modest, but the 10-year dividend growth rate of 16.8% is exceptional. The dividend has been growing faster than almost any sector on this list. At an average annual return of 9.24%, $100,000 in FHLC grows to approximately $283,300 after 10 years. After 20 years, $931,000. And after 30 years, approximately $3,963,000, with annual dividends reaching $33,500, or about $2,295 per month by that point. 3 funds in, the 30-year outcomes are already in the millions. But the top 2 funds on this list operate in a completely different league. At number 2, the Fidelity NASDAQ Composite Index ETF, ticker ONEQ. This fund tracks the entire NASDAQ Composite, the index that houses the world's most innovative and fastest growing companies. From 2010 to 2020, the NASDAQ returned an average of 17.5% per year, well above the S&P 500. ONEQ carries a dividend yield of just 0.64%, but its average annual return of 14.44% is what makes it extraordinary. At that return rate, $100,000 grows to approximately $401,500 after 10 years. After 20 years, $1,577,000. And after 30 years, approximately $6,134,000. $6 million from a single $100,000 investment held for 3 decades. Apple, Nvidia, and Microsoft make up nearly 40% of the fund, with technology accounting for over half of total assets. For the investor who believes in the long-term trajectory of innovation and technology, ONEQ is one of the most powerful wealth-building vehicles available. But it is still not number 1. At number 1, the Fidelity MSCI Information Technology Index, ETF, ticker FTEC. This is the concentrated version of everything that makes ONEQ powerful. FTEC invests almost entirely in information technology stocks. Apple, Microsoft, and Nvidia alone make up nearly 50% of the fund. Software, semiconductors, cloud computing, artificial intelligence, the entire technology ecosystem in a single fund. The current dividend yield is just 0.66%, but the 10-year dividend growth rate is 19.08%, the highest on this entire list, and the average annual return has been 18.67%. At that rate, $100,000 in FTEC grows to approximately $586,500 after 10 years. After 20 years, $3,442,000. And after 30 years, the projection reaches approximately $20,174,000, over $20 million. From $100,000 invested once, held consistently for 3 decades in a single Fidelity index fund. This is the fund that makes the number seem almost impossible, until you look at the 18.67% historical annual return and realize the math is straightforward. Concentrated technology exposure over 30 years of compounding is what produces that outcome. The risk is real, technology is volatile, and FTEC will experience significant drawdowns. But for the investor with a 30-year horizon who can hold through those declines, the historical data shows what patience in this fund has been worth. Set things in motion today. Open a Fidelity brokerage account if you do not already have one. Decide which of these 5 funds matches your risk tolerance and time horizon, and automate a regular contribution on top of your initial investment. Because the $100,000 starting point is powerful, but consistent monthly additions accelerate the timeline dramatically. The biggest mistake with index fund investing is not the fund selection. It is the inability to hold through volatility. Every fund on this list has experienced significant drawdowns. The investors who captured the 30-year returns are the ones who stayed invested through all of them. Start today, stay invested, and let the math run. If you have made it this far, you are already thinking about your $100,000 differently than you were 13 minutes ago. You are someone who wants to understand what their money can actually do, not just let it sit. And I am going to guess you have already subscribed to this channel. If you have not, do it now and watch the next video on screen. We already broke down the 5 AI ETFs that could make you rich in 2026, and the technology exposure in FTEC connects directly to everything covered there.